United States, we're awaiting some more inflation data, which is going to show some big price increases, and we're increasingly hearing hawkish talk from the U.S. Federal Reserve. That has rattled markets, particularly tech stocks. We saw a big drop for the NASDAQ last week. Let's bring in Michelle Schneider. She's Managing Director at Market Gauge to talk a little bit more about the market dynamics outside. Michelle, nice to see you. Outside of the continued headlines coming out of Ukraine, it's hard to think of a narrative in the market that's getting more attention than this transition to hawkish central banks that are fighting inflation.
Well, absolutely. And you do have a lot of headlines coming out this week because given the hawkish statements, you also have PPI, CPI, consumer sentiment, and as you mentioned earlier, the start of earnings season. So you've got all of that to contend with. A lot of more Fed speak this week. I think they've already kind of said their piece. So it's really going to come down to a matter of how aggressive they really are going to be. And regardless of how aggressive they're going to be, is it going to be aggressive enough, a la Volcker days, to really stop inflation dead in its tracks, considering we still have a lot of reasons to fear that inflation isn't over besides the Ukraine. We have China back on lockdown, which when they reopen will again limit supply chain. And so it's a big old mess out there for the Fed, and they're under a microscope. They've certainly spooked the market, but I think what's amazing is the market hasn't been spooked enough, really. We're still very range bound.
So when you say that, like, what would have been the trajectory for the markets that you think would have made more sense? We alluded to the fact that the NASDAQ's taken quite a hit. I think the NASDAQ 100 lost more than $1 trillion in market value in the past 4 sessions.
And that is exactly what we would have expected. And certainly there was plenty of time for investors and lots of warnings, including from us, to get out of the growth stocks in the face of the fact that the yields would have to rise, and the day of low interest rates are over, probably at least in my lifetime. So yeah, but it still has not necessarily taken out the February lows, and it still hasn't really necessarily gone to even where it was trading back in 2021. So this is, to me, a normal event given the yields. But I think that maybe the market is waiting on some kind of hope that we'll see stronger earnings, at least in the big cap stocks. The bank stocks may not necessarily be the barometer, but it will be some sort of a barometer. And of course, what happens now after we had the Fed meeting last week and the minutes came out that they are planning to be more aggressive, the dot plot showing higher yields overall. We'll see what happens. But does the Fed really want to send us into a tailspin with recession talk ahead of midterm elections here in the United States? That's another big question out there.
Yeah, it is. And as I alluded to, we're going to be watching what the Bank of Canada does with their higher rates. And certainly our housing market's going to be keeping an eye on that, which has direct ties to the banking industry. To your point about banks, by the way, we've got a lot of those U.S. banks reporting quarterly results this week. So we're going to have a flurry of headlines to digest. I alluded at the start of the hour to the market flows so far in April. So, for example, here in Canada, we've seen some of the most popular trades of 2022, energy, materials, which had been standouts. Investors have continued to gravitate towards those names. We'll see what happens. Oil's off a little bit today. But they have also noticeably started to add defense to the portfolio. You're seeing more people put money into things like consumer staples and telecoms and utilities. Is that a trend you're going to continue to expect?
Well, the one that I might put a question mark on would be utilities, because utilities are actually interest rate sensitive. So there may be a point where utilities stop going up and some of these other areas like consumer staples and defense and certainly commodities continue to go up, or at least consolidate at current levels or maybe even a little higher. I mean, it's interesting with the energy market because it kind of parallels what happened back in the 70s in that the energy market was the first market to explode. That actually came off. And then some of the other commodities took flight. And that's kind of what we're seeing here. And of course, everybody's talked about why buy gold, why buy silver? They've just been sitting around. But the truth of the matter is now, especially as we're seeing the pre-open here today, they are coming in stronger. They're starting to pick up. So I wouldn't be surprised to see money start to flow into the precious metals now for real, because people will have to start paying attention to the fact that not only have they held up, outperformed in the first quarter, particularly gold, but here we are on a day where we're coming in lower again ahead of all these statistics, and gold and silver look like they're going to be strong.